Hi everyone, it's Jack back with another video. Today I'm going to talk about PayPal, a stock that has an absolutely terrible 2-year run, down about 80%, 79%, really rough, even rough year this year, 52-week highs of $100, currently at 64, not far off its lows, now just a $70 billion company or just higher, and its PE ratio on a trailing basis still actually looks quite high for the levels of growth we've seen. It's a business that's really fell off its pedestal as a growth darling for a long time. No longer the exclusive payments platform for eBay. The rise of Adyen, Stripe and many other in-house payments platforms means there's a lot more competition. PayPal's no longer one of the only games in town. With that being said, I think this business has definitely been oversold and a lot of its future prospects have been heavily discounted. It still has Venmo, it still has its cross-border payments which do very well, has a lot of members and a really high total payment volume that can be easily monetized better in my opinion. It's just management has been very poor at optimizing this business. So for me, it's a little oversold and I think there could be a decent amount of opportunity here. So I'm going to talk through the most recent results, talk through the plan for the future, and then just establish whether I think this is a buy, sell or a hold and what is an appropriate price for this business. PayPal was spun off by eBay in 2015, so even now it's up 100%-ish since its IPO, although those returns are not exactly spectacular, and any investor who bought after 2019 is probably pretty unhappy. However, since 2015, it's had some pretty impressive growth, and over the last 5 years or so, the 5-year compound annual growth rates, while not absolutely spectacular, are still nothing to sniff at. 14% compound annual growth rate over the last 5 years for active accounts, 24% for total payment volume, 16% for net revenue, 17% for non-GAAP EPS, which I'm not so interested in non-GAAP numbers, but free cash flow, 22% every year for 5 years, which is relatively impressive, particularly for a business at this size and scale. In 2017, it was not a small company by any means, over 200 million active accounts, and in the $300 to $400 billion total payment volume range. So I think this is reasonably impressive. However, the growth has just not sustained into the most recent quarters. It's easy to see, aside from a general contraction in growth stocks, why this business has come down so much. That's simply investors are no longer willing to pay 2019 multiples for this business. Now its revenue growth is not exactly drying up, but it is definitely contracting. 2019 this business was trading around 30 times cash flow. Currently it trades under 15 times cash flow, so that's a contraction of 50% immediately, and the stock has done much worse than that. We now have to be happy with 8.6% actual revenue growth and 10.4% on a foreign exchange neutral basis, and this is relatively good numbers, a decent acceleration quarter over quarter, and probably about par for where it's been over the last 2 years or so. Total revenue grew 9%, transaction revenue grew 6%, driven primarily by Braintree. Other value-added services increased 39%, so this is a nice driver here, but still a relatively small amount of revenue. They didn't really gain anything hedging, and overall, this is not as good as a quarter as Q4 for obvious reasons, because there's a degree of seasonality with spending. Decent progress, and this is kind of what happens to these high growth businesses. Eventually, not every company can accelerate all the way up to $1 trillion like the likes of Google, Amazon, etc. There is a stage where it moves from growth to value, and I feel like that is clearly what is happening with PayPal right now. Total payment volume is obviously a key metric when looking at the payment companies in general. Any of the fintech businesses, total payment volume is a key indicator here. Slagging slightly behind revenue, up 12% on a foreign exchange neutral basis to $355 billion. Of that, peer-to-peer total payment volume increased just 2% to $91 billion, now represents 26% of total payment volume. This is the real growth engine for this business, in my opinion, except that it isn't really growing right now, which is some concern. That is primarily because Zoom and PayPal are dragging down Venmo. Venmo is the jewel in the crown of this business, in my opinion, at a total payment volume of $62.7 billion. So the lion's share of that peer-to-peer PayPal revenue, and this accelerated 6 points versus Q4 2022. That's a nice acceleration here, but overall total payment volume growth has been drying up, again like revenue from Q4 2021 where it grew 23% on a foreign exchange neutral basis. We're happy it's back in the teens after a miserable Q4 report, but not particularly impressive in my opinion. CrossBorder Trade is worth mentioning. It's around a 13% share of the total payment volume for this business, primarily e-commerce goods related activity, limited exposure to the recovery of travel, really not many people travelling and paying by PayPal, and this was up well, it was actually flat year over year on an actual basis and up 4% on a foreign exchange neutral basis, but I prefer the actual numbers. They believe it was driven by intra-European corridors being a bit soft and softness in EU, UK and US China corridors. Now, this business segment has been a bit all over the place. I'm going to discount that a little bit because I don't think it's really fair to ding them that much, because generally geopolitics has been a bit all over the place recently, in particular with the pandemic in 2021. They had a massive boon in cross-border trade. However, right now, I don't think this is a business segment that matters too much. The peer-to-peer and the business-to-business segments are much, much more important. Account growth, which at one point was a key indicator for this business, they had a very lofty goal of something like 750 million accounts, which they're looking like missing by a long shot, and management have kind of revised this because it was way off. They processed 5.8 billion transactions, which is up 13%. Active accounts grew just 1%, so you look at the Q4 2021, it was up 13%, then 9, 6, 4, 2, 1. So the active account growth is really, really drying up here, and that is kind of to be expected. They now have 433 million active accounts. There's a lot of competition in this space. I don't expect this to keep on going up. It was more that management thought it was going to a couple of years ago. I think that's been a pretty embarrassing for them, in my opinion. Next, I want to talk about its operating margins, which at 14.2%, because I only really care about the GAAP operating margins, is a decent year-over-year return, where the previous year it was only 11%. However, quarter-over-quarter, this is down 2% from around 16.8%, and in Q3 it also managed a 16% GAAP operating margin, so this is a little disappointing. Generally, margins are looking better here, not spectacular. Payment companies generally can have absolutely exceptional operating margins, and PayPal isn't really managing that, in my opinion. But I think for where this business is going, an improvement year over year is absolutely what we want to see, and 14.2% GAAP operating margin is not the end of the world, in my opinion, at all. Volume-based expenses grew 16.9%, so there was a decent amount of growth in expenses. It now occupies around 70 or 77% of revenue, which is a little bit too much, in my opinion. Of particular concern for me is the free cash flow numbers. Free cash flow as a percentage of revenue was just 14% for this quarter, whereas the year ago quarter is 16%. The Q4 numbers are often much higher, so in Q4 2021 it's 21%, Q4 2022 19%, so the quarter-over-quarter numbers look pretty putrid, but even year-over-year we don't want to be seeing this. Free cash flow just $1 billion on the amount of revenue this is doing for a payments company is not really good enough, in my opinion, considering it's such a low capex amount. So it declined 3% primarily due to higher cash taxes, blah blah blah, not really good enough in my opinion. However, free cash flow, this business doesn't pay a dividend, is highly acquisitive but maintains an excellent balance sheet, in my opinion. 15.3 billion in cash and cash equivalents, and long-term debt of just 10.5, so a nice ratio there, although in my opinion it shouldn't really have that much long-term debt for this business. Often its acquisitions are very shrewd. It missed a bullet, in my opinion, well, for both sides, desperately trying to grab at Pinterest a couple of years ago. Just made the right decision there, or perhaps it didn't make that decision itself. However, I see more small add-on acquisitions like it did with Payday, like it did with Venmo once upon a time, like it did with Zoom. See more of these in the future, and preserving this balance sheet and producing more free cash flow is absolutely crucial, and potentially paying a dividend going forward, because I see no reason in the current growth state this business is in why it shouldn't be setting and paying a dividend. On a relatively bullish note, there was some Nielsen survey done recently, and this is the type of thing that businesses absolutely eat up when potential clients for PayPal are coming in. PayPal brings 20% more repeat buyers based off this survey. PayPal users make 60% more purchases, completes 33% more checkouts, and that is an experience. The PayPal experience generally has not always been completely positive from my personal experience, but I think it is a lot better recently. Improves purchase experience by 28%, so promotes loyalty, and PayPal increases likelihood of buying again by 25%. All these metrics are exactly the type of thing that its clients will absolutely eat up, not to mention the massive amount of accounts and the general network effect this business has. So I think these are all definitely bullish notes, in my opinion. Overall, as with any stock market investment, it's talking about risk versus reward and margin of safety. The margin of safety of this business is dramatically lower than what it was a while ago. Price to cash flow now just around 12.5. That's significantly below its 5-year averages, and so it should be because it's nowhere near the revenue growth. It cannot command the same multiple it previously did. Price to earnings on a trailing basis, 26.7, way below its 5-year average. Forward earnings, which obviously matter a lot more, about 13, way below its 5-year average, as again, to be expected. But this business now, in my opinion, particularly looking at the PEG ratio, looks fairly undervalued, offers the best earning yield it's ever offered at nearly 4%. And then there's definitely some value to be added here. Yes, this is not a perfect business by any means, but I think with some management changes and a change in attitude of management particularly, there's meat on the bone here. Margins can be improved, free cash flow can be improved dramatically in my opinion. They're a very acquisitive company that has generally made excellent acquisitions in my opinion. Buying Paidy, they're effectively when Square bought after PayPal bought Paidy, that was a much more shrewd acquisition, not throwing a load of shares and diluting shareholders. It's generally been a good business to be a shareholder of, other than the last 2 years where the stock price has completely plummeted, but I think it's generally been oversold and there's clearly some value here. I am a PayPal shareholder and my cost base is probably around 80, so I'm decently down on this position and I'm actually fairly happy with it. I'm probably going to be adding some more because I think, again, the value presented here, it's a relatively small position for me. I think the value presented here is really nice for my portfolio. I've done decent space, I'm not so overexposed to payments. I think value wise around 13 times cash flow and less than 15 times future earnings, I think that's fair. I think this is better than the average S&P 500 company. However, it trades for a discount to the S&P 500's forward earnings, and right now around 19. Whether analysts revive that is another thing entirely. So I'm going to be adding to my PayPal position. I think it's a buy going forward. But of course, it's just my opinion. I'm not a financial advisor. You should do your own research and due diligence. Capital is, of course, at risk when investing in stocks. You should do your own research and due diligence, not just buy things because I think it's a buy and I'm buying it myself. Do your own research and due diligence. Contact a financial advisor. Like and subscribe if you enjoyed the video. Let me know what you think in the comments down below about PayPal. Whether you think it's a value trap, whether you think it's an excellent opportunity, whatever you think. Let me know down in the comments below. See you again next time.